What if the biggest financial hit to your pension this year isn't a scam, isn't a mistake, and isn't even hidden? It's sitting right there in the rules, waiting quietly for you to miss it. Before I tell you what it is, I need 30 seconds of your time. If you've ever felt like the system changes its mind without telling you, hit that subscribe button right now, tap the like, and share this with the one person in your life who still opens their post a week late. Because what I'm about to explain won't wait for anyone, and it definitely won't wait for you to find out the hard way. My name is Daniel Foster, and every week I go through the paperwork that most people never read properly, the letters, the small print, the quiet policy updates buried on government pages nobody visits. And this week, three separate changes are lining up at once for anyone who is a pensioner or who receives any payment from the Department for Work and Pensions. None of them arrived with fanfare. None of them came with a plain English explanation, and every single one of them can cost you real money if you find out about it after the fact, instead of before. Here is the uncomfortable truth about how this system works. It does not chase you down to warn you. It does not ring your doorbell to check you understand what's changed. It sends one letter, usually written in language designed by a committee, not a human being, and it expects you to have already known the rule before you broke it. That is the entire game. Knowledge before the letter arrives, not panic after it does. So let's get you that knowledge right now, one piece at a time, starting with the change that's catching out the most ordinary, hard-working pensioners in the country. It begins with winter fuel payment. If you've watched the news even a little, you'll have heard the reassuring headline, "Winter fuel payment is coming back for almost everyone this year." And that part is true. After the payment was stripped away from most pensioners and then partially restored following public pressure, the government widened eligibility again so that the vast majority of pensioners will see the payment land in their account, just as it used to. On the surface, that sounds like unambiguous good news, and for most people, it genuinely is. But there's a second half to this story that almost nobody explains properly, and it's the part that matters most. If your total taxable income for the year goes above £35,000, you still get the payment first. It still lands in your bank account like normal, showing up in October or November the way it always has. But then, later in the tax year, the government quietly takes it back. Not some of it, all of it, every single penny, clawed back either through an adjustment to your tax code the following spring or through a self-assessment return if you're one of the people who fills one in. Here's why that catches people so completely off guard. Nobody feels wealthy at £35,000 a year. Nobody pictures themselves as the kind of person this rule was written for. That figure doesn't sound like the description of a rich person, and it isn't meant to. But add up your state pension, a modest workplace pension from 30 years at the same company, maybe a few hours of part-time work to stay active and bring in a little extra, and a small amount of interest from savings sitting outside an ISA, and that figure creeps up faster than you'd expect. You don't have to be rich. You just have to be someone who worked hard, saved sensibly, and built more than one small income stream over a lifetime. That's it. That's the profile of the person this rule quietly targets, and it is nothing like the profile most people imagine when they hear the word threshold. Let me paint the picture a little more clearly, because I think it helps to see exactly who ends up in this position. Imagine somebody who spent 40 years working in a steady, unglamorous job. They paid into a small company pension the whole time without really thinking much about it. They retire, start receiving their state pension, and their workplace pension kicks in alongside it. To keep busy and to feel useful, they take on a few hours a week somewhere local, maybe helping in a shop, maybe doing some light consulting in whatever field they used to work in. None of this feels like wealth. It feels like a normal, sensible retirement built the slow way, over decades. And yet when you add the state pension, the workplace pension, the part-time earnings, and a little savings interest together, that person can end up a few £100 over the 35,000 line without ever once thinking of themselves as high income. And because of that, the winter fuel payment they were delighted to hear was returning gets quietly taken back through their tax, often without them understanding why their tax code suddenly changed the following year. So what do you actually do about this? First, take 15 minutes this week and add up everything that counts as taxable income. Your state pension, any private or workplace pension, any part-time earnings, any savings interest that isn't sheltered in an ISA. Put it all in one column and get an honest total. Don't guess, actually write the numbers down. If you're comfortably under 35,000, relax. None of this touches you, and the payment is simply yours to keep, no strings attached. But if you're close to that line, or clearly over it, you have a genuine choice to make. You are allowed to opt out of receiving the winter fuel payment altogether in advance, so the money never lands in your account and never has to be clawed back later through your tax. Some people strongly prefer that approach. They'd rather not watch the money arrive in October only to disappear again through their tax bill the following spring, because that feels like losing something they never really had. If that sounds like you, contact the Winter Fuel Payment Center directly, have your national insurance number ready, and tell them clearly that you wish to opt out. There is a cutoff date each year to do this, so don't leave it sitting on your to-do list next to the other things you keep meaning to get round to. And if you're simply not sure where you stand, the government website has a short calculator that will tell you in a few minutes, completely free of charge. Spending 15 minutes now genuinely beats spending an afternoon on the phone arguing about your tax code next April. Now let's move to the second issue, and this is the one that generates the most fear online, often because it's explained badly or deliberately exaggerated for the sake of clicks and shares. Over the past year, new powers have allowed the DWP to work with banks and building societies to flag accounts belonging to certain benefit claimants. And I want to be completely straight with you about what that does and doesn't mean, because there is a lot of frightening nonsense circulating right now, and you deserve facts, not fear. Here's what's actually true. This only applies if you are receiving a means-tested benefit, things like pension credit or housing benefit. If your only income is the state pension itself, this entire system does not touch you. None of it. You can breathe out completely. For those on a means-tested benefit, there's a savings limit of £16,000. Go above that limit and you're no longer entitled to that particular benefit. Under the new arrangement, banks can flag an account where the balance appears to cross that £16,000 line, which allows the DWP to check whether payments are still being calculated correctly for that person. Now here's what is not true. And it deserves to be said plainly and repeated, because so many people have been frightened by half-truths. The DWP cannot log into your bank account. They cannot watch your day-to-day spending. They cannot see what you buy, where you shop, or how you choose to live your life. There is no surveillance dashboard tracking your card transactions in real time. What actually happens is far more limited. A simple flag is raised if a balance crosses that threshold, and a human being then has to review the case properly before anything happens at all. Nothing is automatic. Nothing is instant. This system is also being rolled out gradually, in stages, tested carefully, rather than switched on everywhere overnight. So please don't let anyone frighten you into believing the government is watching every pound you spend. That simply isn't how any of this actually works. No matter what headline you saw shared in a Facebook group. What actually matters, and this is the part genuinely worth paying close attention to, is understanding what you're required to report yourself. Because the real danger here was never dishonesty. It's people getting caught by a rule they never knew existed in the first place through absolutely no fault of their own. If you receive pension credit or housing benefit, you're required to report certain changes in your circumstances, and that list is considerably longer than most people assume. You need to report any change to your savings or capital, including a one-off lump sum, like an inheritance, money from selling a property, or a withdrawal from a pension pot, even if that money only passes through your account briefly on its way somewhere else entirely. You also need to report a change of address, a change in who lives with you, a trip abroad longer than 4 weeks, or a change to your income, however small it might seem at the time. This is where good, honest people get caught out completely by accident, and it happens more often than you'd think. A temporary rise in savings, money that arrived and then left again within weeks, still has to be declared while it's sitting there. Most people have absolutely no idea that applies to them until it's already too late and a letter has arrived asking awkward questions. And that gap in understanding is exactly where trouble begins, not because anyone did anything wrong, but because nobody ever explained the rule in the first place. So here's what to actually do, and it's genuinely simple once you know it. Sit down this week and think honestly about whether anything on that list has happened to you recently without being reported. Did you receive a lump sum? Has your living situation changed in any way? Did you take a longer trip abroad than usual to see family? If the answer is yes to any of it, report it now, voluntarily, before a bank flag turns it into a defensive conversation later on. Reporting a change yourself is completely routine and causes no trouble whatsoever. It's treated as exactly what it is, a person being honest and organized. It's the change that surfaces on its own, months later, through a flag rather than through you, that turns into a difficult and stressful conversation. You can report changes through your online account or by calling the Pension Credit Helpline directly, and either way takes far less time than people assume. And if you're ever unsure whether something even counts as a reportable change, just ask. There is never any harm in mentioning something that turns out to be nothing at all. There is real harm in staying quiet about something that mattered and hoping nobody notices. I've come across cases that show exactly how innocent this can be, and I think they're worth hearing because they take the fear out of the situation. Picture someone who sells a small property or receives an inheritance after losing a parent they loved. That money sits in their account for a few weeks while they decide what to do with it. Maybe they're about to pass some of it on to their own children, or move it into a different savings account entirely, or simply haven't got round to dealing with it yet because grief takes up most of the available energy. For that brief window, their balance crosses the £16,000 line. The money was never really theirs to keep long term. It was passing through, on its way somewhere else. But that's still enough to raise a flag. There was no dishonesty here at all, just a person who never realized a temporary rise in their balance was something worth mentioning to anyone. And that's precisely why understanding these reporting rules matters so much, more than almost anything else in this video. The person who knows the rules is completely safe, every time. It's only the person who doesn't know them who ever runs into real difficulty, and that difficulty is entirely avoidable. Before I get to the third change, and this one affects a huge number of families directly, often without them realizing it applies to them at all, I want to pause for a second favor, because I know some of you are watching this while genuinely worried about someone you love. If that's you, do one simple thing right now: tap share, and send this video to them, not later, when you remember. Now, while it's actually on your mind and the thought is fresh, that one small action, taking 10 seconds out of your day, could genuinely be the difference between them finding out from a confusing letter months from now, or finding out today from someone who actually cares whether they're financially safe. Now, the third thing, and I'd argue this one is the most emotionally significant of all three, because of who it affects. This is a mix of genuinely good news and a hidden catch that almost nobody explains properly, and it concerns anyone receiving personal independence payment, commonly known as PIP. The government has confirmed that award reviews are becoming far less frequent for most existing claimants. Where some people used to face reassessment every 9 months or so, even in cases where everyone involved already knew their condition was never going to improve, which caused enormous unnecessary stress for no real reason, the minimum gap between reviews is being stretched significantly, often to around 3 years for most existing claimants, and considerably longer after that. For anyone who has lived through the exhausting cycle of repeated assessments, filling out the same forms again and again, sitting through the same uncomfortable appointments, that change is real, genuine, welcome relief. Fewer forms, fewer stressful appointments, fewer sleepless nights in the weeks leading up to an assessment letter arriving on the doormat. But here's the part nobody sits people down and explains properly, and it's the part that quietly costs people money in both directions if they're not paying attention. Because the DWP is reviewing people far less often now, the responsibility for keeping your award accurate shifts almost entirely onto you as the claimant. And crucially, it cuts both ways, not just one. If your condition has gotten worse since your last assessment, if you genuinely need more support now than your current award reflects, whether that's due to a condition that's progressed or new difficulties that have developed over time, nobody is going to notice that on your behalf. Nobody is going to call and check in periodically the way they might once have done. Your award will simply sit at its old level year after year, quietly underpaying you for exactly the support you need, unless you personally take the step of asking for it to be looked at again. This is where I want you to really listen closely, because this is where the quiet, proud people lose out the most, and it breaks my heart a little every time I hear about it. There are people living with conditions that have slowly worsened over years, still being paid at a level set for them a long time ago, back when they were managing noticeably better than they are now. They don't complain. They don't like to make a fuss. It genuinely never occurs to many of them that they're even allowed to ask for a review, because for their whole lives they've been the kind of person who just gets on with things quietly. Under the old system, frequent reassessments might eventually have caught that change on their own, almost by accident. Under this new system, that accidental safety net is gone entirely. If you are managing worse than you were, you are fully entitled to request what's called a change of circumstances review, and you may well be owed considerably more than you're currently receiving. Please don't sit quietly on an award that no longer reflects your real current life. You have earned the right to ask. And the other side of that same coin matters just as much, and I don't want to skip past it, because fairness matters here too. If your condition has genuinely improved and you're now receiving a higher rate than your situation currently justifies, you are required to report that too. Quietly continuing to accept a higher payment after your circumstances have genuinely changed is exactly the kind of thing that turns years later into an overpayment demand, with the money clawed back from you all at once, often at the worst possible time, and often with added stress that could easily have been avoided. So the honest position, in both directions, is refreshingly simple. Keep your award matching your real current situation, whatever that situation happens to be. If you're worse, claim what you're rightfully owed. If you're better, say so honestly. Either way, you're fully protected, and nobody can ever come back to you later with a demand you didn't see coming and couldn't have prepared for. Now let's connect all three of these together, because there's one thread running underneath every single one of them, and it's the entire reason I sat down to make this video in the first place. In every case, the system is not going to come looking for you first. Nobody is going to ring you about your winter fuel payment being clawed back through your tax code next spring. Nobody is going to knock on your door before a bank flag quietly becomes a formal review of your pension credit. And nobody is going to check on their own initiative whether your PIP award still genuinely matches your current health. The responsibility in every single one of these three situations has quietly shifted onto you, the person actually living the life in question. That might sound unsettling when you first hear it laid out like this, but I want you to hear it differently, because this is actually where your power genuinely lives. Every one of these situations can be handled completely, cleanly, and without any real stress at all, if you simply get ahead of it before it gets ahead of you. The person who checks their own paperwork this week is the person who never gets caught out, no matter what letter eventually arrives. The person who waits for the letter to show up first is the person left scrambling after a deadline has already quietly closed behind them. I know hearing three separate warnings in one video can feel heavy, almost as though the whole system is deliberately stacked against ordinary people. I want you to take the opposite feeling away from this instead. Knowledge is the single thing that removes the fear from all of it, every time. Every one of these issues has a simple, doable action attached to it. None of it is beyond you, whatever your age, or however unfamiliar this all feels. None of it requires a solicitor, an accountant, or a specialist advisor. It just requires about 15 minutes, and in most cases, a single phone call. So here's exactly what to do this week, laid out as plainly as I can make it. First, add up your total yearly taxable income and check honestly whether you're above that £35,000 line for winter fuel payment. If you are, decide calmly whether opting out in advance makes more sense for you personally than watching the money arrive and get clawed back later. Second, if you receive pension credit or housing benefit, think carefully and honestly about whether any recent change, savings, living situation, time spent abroad has gone unreported. If it has, report it yourself, in the open, before it's ever found for you by someone else. Third, if you or someone you love receives PIP, ask honestly whether the current award still reflects the real situation today, right now, not 2 or 3 years ago. If it doesn't, in either direction, put it right yourself rather than waiting. Every single one of those is a small action, a phone call, 15 minutes online with a calculator, and every one of them puts you back in control, firmly ahead of the system, instead of reacting to it weeks or months after the fact. There's one more habit that protects you across all three of these situations, and it might genuinely be the single most valuable thing I tell you in this entire video. So please don't switch off before this part. If a letter from the DWP ever does land on your doormat, whatever it says, however official or intimidating it looks, do not put it in a drawer and hope it quietly resolves itself. In almost every case, you have 1 calendar month from the date printed on that letter to request what's called a mandatory reconsideration, essentially, formally asking them to look at the decision again with fresh eyes. If a decision was wrong or made an error, and this happens more often than you'd think, you have every right to challenge it. But that right runs on a clock, and the clock starts the moment the letter is dated, not the moment you finally sit down and open it. Open it straight away. Read it properly, even if it's uncomfortable. Act on it within that month, without delay. The people who respond in time are always in a far stronger position than the people who let the deadline quietly slip past them while the letter sits unopened on the kitchen counter. That one habit, never letting an official letter sit unread, will protect you more reliably than almost anything else in this entire video. And it costs you nothing but a few minutes of courage. Let me leave you with one last thought before we finish, because I think it matters more than any single fact I've given you today. None of these three changes exist to punish you. They exist because the system has quietly redesigned itself to expect more from you and less from itself. That's not fair, and I'm not going to pretend it is. But it is the reality we're all operating in now, and pretending otherwise doesn't protect anyone. The only real defense against a system that no longer warns you is becoming the kind of person who checks anyway, who reads the letter the day it arrives, who adds up the numbers before being told to, and who asks the question before being asked it. That's not extra effort. That's simply staying one step ahead, which has always been the safest place to stand. Before you go, I want to ask you for one thing, and I promise it takes less effort than making a cup of tea. Send this video to someone you care about who's over 60, or to anyone you know who receives pension credit, PIP, or any payment at all from the DWP. Statistically, there is almost certainly someone in your life right now who is about to be caught out by one of these three changes, simply because nobody ever explained it to them properly, the way I've tried to explain it to you today. One short message from you sent today rather than next week could genuinely save them a significant amount of money and an even larger amount of stress and sleepless nights lying awake, wondering what a letter actually means. If this video gave you something useful today, don't let it end here on your screen. Send it on to someone who needs it. Hit that like button so more people like you get to see it before it's too late for them to act. And subscribe, because I go through changes exactly like these every single week, long before most people ever hear about them anywhere else. I'm Daniel Foster. Stay ahead of the letter, not behind it. I'll see you in the next one.